Abigail. To say that this week has been a volatile week would be an understatement. We're seeing that reflected in the VIX and the VXN, and of course, we have a big options expiration day here that's probably fueling some of that.
Yeah, it's a pretty brutal week, and we who speak about the markets, we're missing out on the pain that those who trade. A lot of traders out there are saying that this is one of the most difficult environments that they have seen in many, many years. One trader saying one of the most difficult environments in his 22-year career reminds me of 2011 when I did a little bit of trading in tough times. So yes, all about this volatility. Let's bring in Christian Fromhertz of Tribeca Trade Group. Christian, you are a big-time trader, and I imagine that this is definitely a difficult time, given the fact that right now that New York FANG index, that big tech index, down 5%. Its worst day going back to March of last year. The NASDAQ 100 heading to its worst week since March of 2020. If the year were to close right now, the worst year since 2008. Big selling pressure. Are you seeing any signs of relief in the options market?
Yeah, what we're seeing, and great to be here, Abigail. Yeah, I mean, in the options market and basically just, in the whole market right now, we're just seeing while things are kind of unwinding and moving to the downside, today's a little bit different because we're getting the VIX closer to 30, but there's just feels like there's a lot of complacency in the market. We're not really seeing any big major like call buying, that's going on in the option market yet. Just a lot of rolling of put protection right now. So it's kind of interesting, and also in terms of the equity put call ratio, we're not seeing that jump to where we've seen previous sell-offs or previous corrections. It doesn't look like we're there yet in terms of seeing that panic put buying yet.
Okay, so let me see if I'm interpreting what you just said right. It sounds as though there's more room to the downside. Yet, I'd like to bring in the fact that we have the VIX curve inverting for the first time in quite some time. So some see that as a sign of panic. So is there a possibility that as we have all of these indexes testing the 200-day moving average, that perhaps there will be some sort of a solid bounce off, and yet that complacency that you're talking about suggests that there could just be more of the volatility word that Romain was talking about ahead in 2022?
Yeah, I mean, it's definitely a combination of factors, and I mean, and we're moving pretty quickly here. Just a couple hours ago, the VIX was at 25. Now we're pushing 30. So, we could get a little bit of that capitulation towards the end of the day. You also kind of have to think about next week too. We've got a Fed meeting on Wednesday, and it could just be that a lot of funds are just kind of sitting on their hands until we get more information from the Fed. And for now, it's just kind of a constant grinding, unwinding of the longs,
right.
Until, remember, the Fed's in a quiet period this week. So, they came out last week and told us about how many rate hikes we might get. Mm-hmm. So now we've kind of have to, get that actual news on Wednesday, which I'm kind of looking at. It could be one of those buy the rumor, sell the news, or vice versa come Wednesday.
Yeah, interesting. I was just thinking about that Fed meeting could really serve as the true catalyst for a bounce up. Very quickly, Christian, let's tie it off with, we're looking at a chart here of corporate bond spreads really being relatively low. What does that mean to you, especially on this options expiration Friday? Is this options expiration, is that a lot of the volatility that we're having here today?
Yeah, I mean, it's another one of those head scratchers, right? Normally you would see on a move like this that we've been seeing since the beginning of the year, a pretty big, decent move up and credit spreads widening. We're not seeing that right now. So, while it's a complacent sell-off right now, indicated by the put-call ratio and some other sentiment, one of these things that I kind of keep looking at is, as long as credit spreads don't widen that far, I think it's best to kind of stay hedged, wait for the price action to confirm, and then maybe start to redeploy some risk assets.
That makes a lot of sense. Reading the mixed signals and all the volatility. Christian Fromhertz of Tribeca Trade Group, thanks as always for joining us for Options Insight today. And from New York, this is Bloomberg.